Budget 2023 expectations. Shorter holding period for non-equity funds. Hike in equity LTCG limit to rupees 2 lakh. Simplifying the complex capital gains tax regime in India ranks high in Budget 2023 expectations. It can bring cheers to taxpayers and ensure sustained investors' interest. A simple capital gains tax regime helps investors to understand and plan for tax cost while deciding on the investment. The current capital gain tax regime in India is complex. The holding period to identifying whether the capital gain earned is a long-term gain or short-term gain depends on the asset and rate of taxes. Capital gain tax rates and threshold to determine the long-term tax relief are different across investment. Indexation benefit are also asset specific with budget 2023 round and corner. Investors are hoping for a simpler system which would be easy to calculate tax cost and minimize litigations and disputes. Clearly, there is a need to simplify the provisions and minimize complexity. Here are some expectations from Budget 2023. Shorter holding period for non-equity mutual funds. As against the current three categories of holding period, the expectations is that this will be simplified to at least two categories. For instance, capital gain on listed shares is considered as long-term if the holding period is a 12-month. Infrastructure investment trust are categorized as long-term capital asset if yield for at least 36 months to bring parity into tax treatment and for the computation of capital gain tax. The holding period of units of REITs and INVITs invest should be standardized at least 12 months instead of 36 months. On similar line, the holding period of non-equity mutual fund may be brought down to 24 months to equality as long-term asset, non-tax limited on equity LTGC, long-term capital gain from the sale of listed equity shares. Unit of equity-oriented mutual funds are taxable if the gain exceeds rupees 1 lakh per annum. This provision was in introduction through the 2018 Finance Act to the encourage investment in diversifying assets beyond the listed equity shares and equity-oriented mutual funds. These categories of long-term assets have enjoyed total tax exception since 2004, since this transaction was subject to the Security Transaction Tax (STT). While the withdrawal of security transaction tax appears unlikely, the expectation from retail investors is that non-taxable limit of rupees 1 lakh per year could be increased to at least rupees 2 lakh. Hence, rebated and deduction. Capital gain from the transfer of land or building is exception to the extended it is invested in Government of India specified bonds subject to a ceiling of rupees 50 lakh. One of the expectations from the budget is that this limit will be enhanced. Further, this benefit may be extended to all LTCG long instead of limiting it to only gain on sales of land or building. This step will also encourage investment in infrastructure bonds. The current regime does not entail taxpayer to the rebates of up to rupees 12,500 on tax payable on LTCG on the sale of listed equity shares, equity-oriented mutual funds unit and units of REITs and invests which should be permitted. Simplifying the complex capital gain tax regime in India ranks high among expectations from Union Budget 2023. It can cheaper up taxpayer and ensure